Good morning, everyone. Welcome to our Insight60 series. My name's Stephen Shield. I'm External Relations Director at OGTC, and I'm your host for today. Delighted to have possibly around about 140, 145 people join us on the webinar today. And today is going to be a really cool session. I've been looking forward to this all week. How it works is very simple. We have a fascinating presentation from a keynote speaker. We have a panel who asks some questions, and then it's over to the rest of the audience participants to really get stuck into questions and have a great discussion with the panel. So remember, this session is designed to be interactive. Please use this opportunity to come forward with your questions to Rob, either throughout the presentation, just keep logging them, or after, whenever suits you. So before we hear from our highly anticipated guest, Rob Gardner, who's Investment Director at St. James's Place Wealth Management, there are a few housekeeping points I just want to address very quickly. So everyone on this session is automatically muted and your camera is not turned on. You can use the chat function to type in questions, and I would encourage you to submit your questions throughout the presentation. And we're also recording this series. So this is getting recorded as part of a series. So if you're uncomfortable with that, please do take note that we are recording. And if you don't wish to participate, that's perfectly fine. But I hope you stay with us. So without further ado, I am going to introduce our guests. So Rob, welcome to Insight60. Could you give the audience watching right now a short introduction on who you are and what you do, please?
Yeah, Stephen, actually, I had a slide on that to kind of explain it. So maybe if I could open my slide deck with that, that'd be great. Shall I get going?
Yeah, please do.
Brilliant. Well, look, good afternoon, and thank you for inviting me to speak. And I look forward to the discussion afterwards. And really, the context is I've been asked to talk about the impact of responsible investing on the oil and gas sector in the UK, and so why do I even have a point of view? What kind of makes me qualified to talk about that? So I started out actually studying geography and glaciology and hydrology, and I had an NERC scholarship to basically go and study the impact of deglaciation on the Hindu Kush. But I took a different career, and I started working for Deutsche Bank, working in foreign exchange and derivatives. I then worked with pension funds at Merrill Lynch, advising large corporate pension funds around the world on how to manage their final salary pension fund risk. And then I founded a company called Reddington, which is a leading investment consulting company to some of the largest companies in the world and their pension funds, be it Barclays, HSBC, BP, Unilever, Nestle, PwC, Reuters, you name it. And because of that work, I've been lucky enough to be invited to be part of the World Economic Forum Retirement Council, thinking about retirement policy globally. And then 2 years ago, I took on the job of Director of Investments at St. James's Place, where I'm responsible for protecting and growing the wealth of 800,000 clients, literally from babies to, we've got about 200 people over the age of 100. And that's about 130 billion pounds of money that me and my team are responsible for. And I wanted to share with you my insights, both as an institutional investment consultant to some of the largest pension funds in the world, and as someone who is responsible for 130 billion, what is happening right now in responsible investment in ESG, and specifically, what does that mean for your industry? But by way of context, that's me on the left. I was born in Holland in 1978, and my mum and dad were teachers at the British School in the Netherlands, and actually taught a lot of families who work for Shell. And I remember it, at winter the canals would freeze, and we'd ice skate to into town or to school. And I share that because growing up in Holland as a small boy, even then I was acutely aware of the risk of sea level rising and climate change. And many of you will know that that the Scandis and the Dutch are much further progressed on thinking about the environment and the impact of that. And so when I was born, the world population was 4 billion. Today, it's doubled to 8 billion. When I was born, the CO2 in the atmosphere was 335 parts per million, which is below the 350 safe level. As we all know, it's 415. It's probably about 420 today. And over my time on Earth, we've kind of destroyed a lot of wildlife in the process. And we all know that's not a good outcome for anyone. And whilst I was working at Reddington and part of the World Economic Forum, I got to work with some Dutch pension funds. And this is a quote that I heard from the CEO of one of the largest Dutch pension funds. And this is probably in about 2015, 2016. He said, look, the returns we need can only come from a system that works. The benefits we pay are worth more in a world worth living in. So I suppose the point I'm trying to make here is this idea of responsible investing and ESG has been around for a long time. For many of you, it will feel like it's something that has suddenly become something everyone's talking about. But like every idea and every concept, these ideas and concepts have been around for at least a decade, if not longer. And I've personally been working in this space for that time. And so my job is really trying to help our clients achieve financial well-being in a world worth living in. We're trying to help our clients who may live to 100. I mean, the truth is the average person in the UK will run out of money 10 years before he or she dies. We know levels of financial resilience are low. Most people don't have enough money to pay if their car breaks down or their washing machine breaks down. We know that financial difficulty leads to mental health issues. And we also know that money, how we invest our money, is way more powerful in driving the world that we want than where we spend it. So there's two ways that we can change things: how we consume and how we invest. And today is all about how we invest. And then finally, there's this kind of transition to a new capitalist system that's going on. We're moving away from the 1980s Gordon Gekko greed is good, which was basically founded on kind of Milton Friedman economics, to this much more holistic, sustainable world where when business is good, capitalism is good, creating profit is good, it creates jobs, it grows economies and all of those things, but we need to do it in a way where we think about what impact we have on the planet and the people, and really that's what ESG is all about. I just wanted to kind of let you know what our clients think and share some research. But the kind of topic of sustainability, so this is just sort of tracking, social media posts and all the rest. The sort of topic of sustainability had been rising quite significantly. As you can see, it sort of fell off a cliff because of COVID, but that's not because people didn't care about it. It's just because it got drowned out by other topics. And actually it's climbing, and I think we're now back on trend. But you can see it's increased quite a lot since 2017. And again, if we look at sort of social media posts, the online mentions of sustainability is the same, more or less, as the Premier League. So you can see that this topic has entered the public. It's moved from the chief executives of the largest Dutch pension funds in the world and the large asset owners to people who live up and down the country, around the world, saying this is an important topic. Let's understand what's going on. And this is some research that we did with one of our kind of client councils. And 81% of them say that they think every company should aim to be as environmentally and socially responsible as they can. So there were two sections. There was kind of a cohort of clients and then a subset who are SJP clients. 93% of our clients said that they think this is important. And then 55% expect that if they're not, they will be called out in person or in the press or in social media. And again, 60% of all clients in financial services think it is important that that's financial services industry. So that's your bank, your building society, your wealth manager, your insurance company. So HSBC, Prudential, SJP acts in a way that promotes a sustainable world in the future. And 83% of our clients think that's the case. So 83% out of 800,000. We actually have offices in Singapore, Hong Kong, and Shanghai. And when we do the research out there, these numbers are even higher. It's up it's up in the kind of 90% area. So in terms of what I'm responsible for, it is delivering this kind of concept of financial well-being, ensuring that people have enough money to retire on and that people feel protected in a world worth living in. And I really want to focus on the world worth living in. And it's in that context that we believe that we need to act as stewards of our clients' capital to first and foremost. So number one is to deliver investment performance. That is critical. But at the same time, think about how are we generating that investment performance, and are the companies and properties that we're investing in, are they creating external damages that A, will firstly impact future financial performance of those assets, but B, is having a negative externality that isn't correctly priced in by the marketplace. Now, to put in context, right now, I'm responsible for £130 billion. That £130 billion is invested with 38 fund managers around the world, and they collectively invest over £6 trillion worth of assets. And those 38 fund managers with their 6 trillion collectively invest in 68 trillion pounds worth of assets. So the actions that we take, the investment beliefs, the investment philosophy, the way we engage with our fund managers has a direct impact on 68 trillion pounds worth of securities, equities, bonds, and properties around the world. And when I joined in 2019, I set a commitment that 100% of our fund managers will be signed up to the UNPRI, which we achieved last year. And in November, we signed up to what's called the Net Zero Asset Owners Alliance. And I'm going to talk more about that later. But I think that has a big impact on the conversation today. And we're now one of $5 trillion of assets globally who have signed up to that. So these are all of our fund managers spread all around the world. As I said, all of them are signed up to the UNPRI. And what that means is they have to integrate environmental, social, and governance into their investment decision making. That doesn't mean they can't invest in a company that has a low ESG score, but when they think about how they value and price that security or that investment, they need to take it into account. SJP is rated A+ by the UNPRI, which is the highest that you can be, and 63% of our fund managers are rated A+, which is again the gold standard and double the industry standard. And so this is my dashboard of those 130 billion pounds. So you can see our global equity and international equity are some of our biggest funds, and that's a range of different assets invested around the world. Now, as I said, when we think about investment, our primary goal is generating long-term performance that beats inflation to help grow and protect our clients' wealth. But crucially, what we've said is in every decision that we make in appointing a fund manager, we want to be satisfied that our fund managers are integrating environmental, social, and governance into their decision making. So environment is what's the impact of climate change, energy efficiency, biodiversity, waste, water. Governance, big topic. Alexander Hamilton review came out yesterday, which looks at gender board diversity of the FTSE 100. That was an area where candidly SJP, the company I work for, was behind, and through shareholder engagement, we have improved that score, and that's been recognized. Anti-corruption and anti-bribery, transparency. And then likewise on social, human rights, employee well-being, how do we look after our employees is also important. And so we need to look at these things because actually these are price sensitive information. If you haven't read this book, you can't see it, Impact by Ronald Cohen, I really suggest you do. But he makes the point that ESG data is price sensitive information. If you have a company like Exxon that is creating $39 billion worth of environmental damage, that needs to be priced into their share price. And the reality is some people are and some people aren't. And I think we're going to get into what this means for the oil and gas industry, because this is playing out live as we speak. So I mentioned that we signed up to the Net Zero Asset Owners Alliance, and that means that we need to think about how we get to net zero by 2050. As a business, SJP just published their annual report and accounts, and we produce what's called TCFD, which is the Task Force for Climate-Related Financial Disclosures. So in the same way that we report our revenues and our costs and our P&L, we have to report our Scope 1, our Scope 2, and Scope 3 carbon footprint. The good news is we've reduced our carbon footprint by 50% over the last 3 years, and we're on the journey to net zero. And again, everyone else is doing this. And later on, I'm going to show you HSBC's, but NatWest, Santander. And what we do is we get our fund managers to look at the businesses they're invested in and saying, how does this look? And it's different for oil and gas or automobiles or technology companies. And we need to think through what that means. But I wanted you to know that this is a key lens that is integrated into how 130 billion is invested across 38 fund managers, which is 6 trillion pounds, which is invested across 68 trillion of securities. And so this is fundamental in terms of the decision making, not just for us, but also for banks and insurance companies. And our commitment is to deliver a 1.5 degree world. And so this is what we've signed up to, and there's stuff that we have to do in terms of engagement. So one of the things that we need to do is engage with our fund managers. We need to set sub-portfolios goals. So right now, we're going to be, later this year, publishing our goals to reduce the CO2 footprint of our investment by between 15 and 30% over the next 5 years. We've already, even before signing up, we already have a lower carbon footprint than our benchmarks, and we're going to continue to do that. And then there's a whole load of other stuff that needs to be done as well. But I suppose just in pictorially, what this means is that we need to, on the left, think about how we invest in climate solutions that are part of the way ahead. How do we invest aligned with the United Nations Sustainable Development Goals, and specifically 13, which is climate change? We need to think about carbon offset. And later in the panel, I'd love to have this conversation, because I think we're still at a point of transition. The reality is people say money makes the world go round, and I think that's true, but we're still coming off the petrodollar makes the world go round rather than ESG and RI makes the world go round. So we're on this transition point, and I'm sure different people on this webinar will have very different points of view about where we are on that journey and the rate of change. And I think the rate of change is all important here. We need to engage and look, ultimately, if we engage and we're unsuccessful, we'll divest. And again, we need to think about how we manage that portfolio over time. But crucially, our goal is to make sure that everything we do delivers 1.5 degrees. And by the way, we're growing from 130 billion to 250 billion over the next 5 years, and 500 billion by the end of the decade. So think about that money magnifier increasing through time as we move through time. So we need to think about the risks, and I'm sure you're all aware of stranded assets and the conversation that's been had around coal, but we also need to think about the opportunities and the transition, and there are all kinds of implications on pricing around that. So how do we do that? So first and foremost, we integrate. Our investment beliefs are all about engagement. The reality is divestment as a primary cut doesn't work. As Bill Gates has said, all the companies who've divested from oil and gas, that doesn't really make an impact. What makes an impact is engaging with companies like BP, Shell. As you know, Exxon now has an activist shareholder who is actively saying you need to change the board, you need to take this into account, and you need to do stuff. If that doesn't work, you need to think about exclusions. And then finally, also think about how we transition to the sustainable world. The reality is we've made huge progress on renewable energy, but all that has done is met our increasing global energy demands. It hasn't actually cut in to the delta of change that is needed. So this is taken from my dashboard. So remember, 130 billion pounds. So 3.5% of that. Well, we've got about 2% invested in oil and gas. So 2% of 135 billion pounds is invested in oil and gas. If we were following the benchmark, that would be at 3.5%. So you can see we've already got a 1.5% underweight in our investments. And then on the right, you can see what it looks like for different businesses where we're overweight or underweight in a particular sector. And then when you drill down into that oil and gas, it's not evenly spread. So the companies in blue are the ones who have given a public commitment to net zero. And you'll know better than I have that BP and Shell have recently committed to net zero, as has Total. But I think it's pretty stark. So this is saying that we're not divesting from everyone, but we will only invest with the companies who are engaged, who recognize it. And here's the goal of sustainable investment, this whole idea of being a responsible business and using money to influence those companies to become better long-term businesses. These are brilliant businesses. They've been around for a long period of time. They know how to manage large capex, but we need to stop the capex from extracting hydrocarbons and shift to that kind of sustainable provision of energy. I want to change gears because another area is cars. As you know, transportation is a massive source of emissions. Car companies are some of the largest Scope 3 emissions companies on the planet. And Tesla, if we talk about investments, you can't help but talk about Tesla. But one of our fund managers here is saying, he really likes Volkswagen because he basically thinks that by investing in Volkswagen, you effectively have an EV business embedded inside. So you can see that actually the by 2025, VW will have a much bigger EV suite than Tesla, which is regarded as the kind of industry leader when it comes to electric vehicles. And again, this is how it kind of plays out in an investment world. And just to make the point that this stuff is tipping, this is in December in Europe. So this is European data. What are the best-selling cars? And two of the top 3 best-selling cars in Europe were EVs. So the Volkswagen ID.3 and the Tesla Model 3. And then on the right, you can see that between 2019 and 2020, so in 2019, 6.3% of all cars sold or registered in Europe were EV, and that's had a 4-fold increase to 24%. So the question we all need to be asking ourselves, is the rate of change linear or is it some kind of exponential curve? Drilling down, this is our property fund. Our property fund manager has been shaving the carbon footprint down by 10% every year, from simple stuff changing to LED light bulbs. But this was in the press a few weeks ago, which is the first carbon neutral industrial estate in West London, which we've just completed. So it's not just about VW and Tesla or BP and Shell. This is like down on the ground as we think about our property investments. And again, we invest about £3 billion in property in the UK. Now, I wanted to step back and go, look, this has been going on for a long time. And actually, this journey of TCFD started back in 2015 when Mark Carney was kind of in charge of the Bank of England. And the PRA, which is the industry regulator, was saying, you need to understand the impact of climate change on the insurance sector. Then this idea that we need to disclose TCFD, we need to disclose our financial, this Scope 1, Scope 2, Scope 3, in the same way that we disclose our financial data. So this has been increasing through time. And by the way, TCFD will be mandatory reporting for everyone in the next few years. Something that people forget is, and you may or may not like Theresa May, but we signed up, UK was the first country, or one of the first countries globally, to have it written in law. And by the way, in order to do that, you needed to have complete buy-in from everyone, Labour, Conservatives, Liberal Democrats, all the parties. So do not underestimate how seriously government is taking it. And this is written into law. So this is government investments all coming together. And 2021 is a big year. It ends with COP26 in Glasgow, which was meant to be last year. But just a week ago, the US rejoined the Paris Climate Accord. In a few weeks' time is Earth Day, and Biden has got his big conference. We've got the G7 conference in Cornwall, and I promise you, you're going to see some big announcements from the government around the green agenda, and you've got a whole host of stuff. And as I say, COP26 is going to be a biggie in Glasgow at the end of the year. And here's this thing is really tipping. So as you all know, Andrew Griffith is the MP for Net Zero Asset Owners Alliance. And on the back of London Stock Exchange signing up, so think about it, the London Stock Exchange is signing up, so all the companies that are listed on it. So in order for them to achieve it, their scope 3 will be every company that lists on them. So they're going to now put pressure on anyone who is listed or whoever wants to list. And he says that just between November, we've had a 50% increase in the number of FTSE 100 businesses who've signed up to net zero. And again, this is just in the press making the same point. Everyone from AstraZeneca, Vodafone, Rolls-Royce. This is Santander, again, their commitments. The reason I'm sharing this with you is because the oil and gas industry is dependent on finance, be it equity or debt. This week, HSBC did their annual report and accounts, but this is their TCFD, so Task Force on Climate-Related Financial Disclosures. But you can see their big exposures are actually to the construction industry, but they do have exposure to oil and gas, upstream, downstream, integrated, and they absolutely need to think about what they do in terms of their lending to this sector to comply with their net zero targets. And look, if you want to know what good looks like, look to Singapore. They've just announced their green plan, 2030 commitment. They're going to plant 1 million trees. They're going to quadruple solar energy. They're going to reduce land. They're going to make all newly registered cars clean energy by 2030. So Singapore as a nation state is the gold standard in what this looks like from top to bottom integration. But we're seeing this in the UK. So this BP announced their partnership in offshore wind. And again, they need to shift their capex from oil and gas to renewable. And look, I didn't know anything about this, but because I was preparing, as you know, Aberdeen Harbour has made some really big commitments and really trying to think about how it transitions to net zero in line with the net zero roadmap. So I wasn't even aware of this until I was asked to present, but I just want to show you the direction that it's tipping in. So I think that is my time, Steve, and I'll stop sharing.
Thank you very much, Rob. That was a very thought-provoking presentation. There's a lot to unpack there. And as you can imagine, we're getting a lot of commentary in the chat function and the Q&A. So I'm anticipating some really good questioning from the audience. But let's first go to the panel, who will have the first crack at asking a few questions or making an observation based on what you've just shared with us. And I'm going to introduce Richard first, Richard Pugh from Business Growth Fund, an investor there. So Richard, can you pose your question or your comment to Rob, please, and get us kicked off with the discussion?
Yeah, thank you. I'd just like to understand where you think carbon pricing will play into all of this, and whether it's a good lever for sort of driving change, or whether it just adds another complication.
Yeah, shall I answer that now, Steve? So I think firstly, if in signing up to net zero, you have to look at your operational first. And so when we're looking at business, what we don't want to do, it's a bit like in London, you see people with nice cars, they don't bother paying to park because they can afford to pay the 60 quid fine. So that is the outcome. That behavioral outcome is a bad behavioral outcome. What we need to see is people shift how they operate. So for example, as a business, we source all of our energy 100% from renewables. We need to think about, if we have company cars, how we shift. We need to think about our travel policy. So instead of setting a travel policy in terms of pounds and pence, we set a travel policy in terms of carbon. So that the operational thing has to be first and foremost. The reality is, though, stripping that out means that you need to do offset. Part of the issue with offset right now is there's no kind of credit, there's no kind of S&P or Moody's to say my offset is this or that. So, you know, I offset my personal carbon with ecology, but, you know, is that the best way to do it? I'm happy to pick up that as a separate conversation, a starter for 10, but we know that there are different levels of offset. We've got Brewdog planting trees in Scotland, which is great, but is that the most effective offset? The truth is planting trees is an offset, but it's typically 7 to 10 years from now. It's not in years. So are you offsetting today's carbon or future carbon? So I think first and foremost, focus on operational. Then there is what's going to happen. You just have to think about it. Hopefully what I've painted as a picture is this thing is moving fast. So the demand for carbon offset is only going one way. So my personal view is high quality carbon offsets are going to double in the next few years. That's just a personal view based on how I see the dynamics playing out.
Super, thank you, Richard.
Can I ask one more, Stephen?
Yeah, sure.
So we're seeing, we've obviously got a lot of focus in this area and seeing a massive influx of capital pointed at the whole spectrum of ESG investing, and the E is probably the easiest for people to define. But we're seeing some crazy valuations, and I'm just interested in your view of the risks of a bubble and the risk that then sets back people's investment confidence in whether these are good long-term investments or whether it's too lumpy for the average investor.
You're right. I mean, the outworking of this is it basically, every company has to think about their weighted average cost of capital. How much is my equity and how much is my debt? And effectively, this will increase the weighted average cost of capital for the oil and gas industry and suppress it for anyone in this space. Do not forget the basics of ESG. Interestingly, the Exxon thing is on the governance, not on the E. So the bit they're fixing first is the board. So they're going to the G, not the E. In order to fix the E, you need to fix the G. Actually, fixed income investors have always understood this better than equity investors. So Heathrow has, which is one of the largest infrastructure projects in Europe, has in their debt facilities written in ESG criteria that they have to hit. And just think about what the scope 3 carbon footprint is of Heathrow Airport. It is huge. And so depending on whether they hit their KPIs or not, the rate at which they borrow goes up or down. I think, look, I would say this because I'm a wealth manager. That goes, that's why you need to diversify your assets, right? You don't put all your eggs in one basket, and you just have to follow the Tesla stock price to know that if you're putting all your money because you think this renewable opportunity is the next hot thing, that probably isn't the right thing. Actually, what's really interesting in investing in businesses like Siemens and seeing what percentage of their net revenue is moving into, let's say, the renewable sector, and as I say, supporting that transition. I think that's why I wanted to share the VW case study, because everyone talks about Tesla, but actually, VW will probably end up being one of the largest EV makers on the planet.
Thanks, Richard. Tom, I'm going to come to you next. I mean, obviously, you've got a lot of experience working both in private equity, but also for oil and gas companies and being an advisor. Can you pose your question or observation to Robert next, please?
Yeah, and thanks very much, Rob. I mean, really interesting presentation. I think one of the things, and as Stephen mentioned, I've got a bit of background in private equity. And do you have concerns that for certain sectors and for certain value propositions and investments, this could potentially push investments more in the direction of private equity that may or may not advocate the same level of standards and may look, perhaps bias more to returns rather than some of the measures that you've discussed here?
I think any institutional investor who's investing in private equity, no. So KKR, we've got over £1.5 billion with KKR. It's probably the largest retail private equity mandate in the UK, and we hire them to the highest of ESG standards, and it's written into our contract. If they don't do it, we will fire them. So we engage with them and we will not select them. Likewise with Orchard Street, our property fund manager, that's why they're reducing it by 10%. They've written up their strategy to be completely aligned with UN SDGs, of which 13 in climate is a big one, but there's actually a whole load of stuff around it. So of course, we'll end up with a period of flux where people don't take this into account. But if you're a PE firm and looking for an exit and you want to exit on LSEG and they've signed up to net zero, what do you think the chance of your business exiting onto the FTSE is if they're signed up to net zero. If the reason I shared you the Santander report and HSBC, NatWest, if you need funding, how are you going to fund your business? How are you going to roll it over for the next investment? So any decent investor needs to be thinking in decades, not days. So you need to go to 2030 and work backwards and say, where will the available equity and debt financing be? And who will those providers be? And they're thinking about it. And I think when you think about private equity, because your holding period is 5-7 years, you're naturally forced to think in those time horizons. So I think any institutional investor worth their salt won't fall into that trap.
Super. Tom, anything to add to that?
No. I mean, it's it covers all the bases, doesn't it? I mean, I think there's probably some narrow examples in the short to medium term where I'm thinking, there's some very significant family offices, particularly investing on a yield basis and cash flow basis, just frankly don't need to pay attention to this. I think your point's well made there, Rob, that if you're looking for an exit, you have to think about who you're passing the parcel to, and therefore the standards that they will have to meet. So I think it's a good point.
Look, I'm only talking about institutional. So Scottish Widows just about 2 weeks ago signed up to Net Zero Asset Owners Alliance. You're just going to see anyone who has a workplace pension, anyone in 2-3 years time, if Aegon, Scottish Widows, Net, are not signed up to this, it will amaze me. And that's trillions worth of pounds of institutional money. You're right. Family office money sits outside of that. There's no FCA, there's no PRA, there's no Department of Work and Pensions, but every single one, Department of Work and Pensions, FCA, PRA, are all crystal clear that this is a risk, and integration of ESG is absolutely key. So if you want to sell to capital in that space, I think that is the only way it's going to be.
Super. And last but not least, our very own OGTC's Luca Carrari. Luca, I know you've been attending IP Week this week, and ESG has been a hot topic during IP Week too. So please do ask your question or make your observation to Rob.
Yeah, I'll be quick, hopefully, because I see some very interesting questions also in the chat, so I'm here that we get to the audience. But Robert, I'm interested in your perspective on the global scenario, because the example you made are mainly Western organization with from democratic countries and with a distributed ownership, and yet the emissions are coming from all sorts of businesses in all sorts of the world. So do you see differences in the investment community, international investment community, based both on your clients from wherever they are, a different level of attention to this ESG elements, or the companies you invest in? And that's, I think, particularly important because, of course, global warming doesn't know the boundaries and the borders. Where when we talk about decarbonizing and putting, reducing the carbon, then the EU is talking about a carbon border tax to try to, level the field and avoid giving an advantage to countries or companies that are less, less keen on that decarbonization. I wonder, from your point of view, do you have a perspective of the global dynamic here?
So let me go back to the ESG, not just the kind of carbon and climate change. So when I joined, we had about 60% of our fund managers signed up, and I set this commitment to be 100% by the end of 2020. And then within that, we rate our fund managers on ESG. Our worst rated fund managers were all in the US, and they are our laggards now. And as we go to speak to our fund managers about Net Zero Asset Owners Alliance and working together, the laggards are in the US. What's interesting, when I showed you the kind of our client data at the beginning, actually support in Singapore and Hong Kong is even higher than the UK. The game changer is candidly Trump Biden, because the argument was, why bother when you've got the US, the largest economy in the world, not signed up? And look, we can talk about China as well and President Xi, but effectively for the last 4 years, the reason I think Paris Climate Accord has basically stalled is because Trump pulled out. And then it was hands off the wheel. So we've basically had hands off the wheel for 4 years. We don't need to. Trump, John Kerry, this thing is going to ramp up. And you've got is government, consumer, and investors all going together. At the same time, over the last 5 years, the flow, I should have put a chart in terms of the flow of money into ESG funds or responsible investments. So we're at a tipping point in both investors, government, and consumers at the same time that technology enables us to do it, right? So, we all know that the cost of, renewables is falling. And as these things come together, China's really interesting because China's one of the worst polluters, but is also one of the most furthest developed on renewable. And what no one really talks about is that climate change is also a major source of security risk. So Russia cares about climate change because as the ice caps melt, America can put a submarine right over the top and take out Moscow. China cares about climate change because their biggest risk is mass immigration from India and Bangladesh in a 2 and a 3 degree C world. So there are also strategic military rationale why countries like Russia and China care about climate change, which are different for the reasons that we have talked about. And I think all of these things are coming together. But Luca, there's no doubt that I'd say Scandinavia, I mean, the irony that, Norway, which is the other side from you guys of the same North Sea, is in a completely different place. So Scandinavia leading the pack with Holland, includes Scotland in Holland and Scandinavia. Then Europe, UK, France, Germany leading the way. Singapore is probably the gold standard. Australia is a long way behind. US is a long way behind. And then it varies around the world. So you're right, not all countries are the same. And so it's going to be an interesting few years as we figure it all out.
Thanks very much, Luca. I'm going to move to the audience now. There's a whole stack of questions banked up. First of all, I'd like to go to Charlotte Tyrwhitt Drake. Charlotte, if you're free to speak and ask your question, please do.
Yeah, can you hear me?
Yes.
Yeah. Hi, I'm Charlotte Tyrwhitt Drake. So I'm the CEO of Pensions for Purpose. And I was just wondering, Robert, on your view about donut economics and how that fits. Because obviously what we've talked about here in terms of Tesla is effectively overlaying ESG onto traditional kind of ways of producing and manufacturing. And how do we actually start to really move off fundamentally in terms of how we think about economics? How do we move from ESG risk mitigation towards investing in intentional, positive environmental and social impact opportunities?
Yeah, so look, I obviously, if I was presented to a different audience, that's exactly the talk that I would do. This has been very focused. So I don't know if everyone on the call knows what donut economics is, but it's based on, is it Kate Raworth?
That's right, yeah.
Economics.
Right.
So when I talk about financial well-being in a world worth living in, it is absolutely about ESG. So I'll give you an example. Levi's jeans have, as a result of ESG, have introduced a waste less water, which means that when you manufacture jeans, they now waste 97% less water than they used to. Coca-Cola has had a 50% reduction in the amount of sugar that they have in their drink. You may or may not like Coca-Cola, but this is engagement. Molson Beer has reduced the amount of water it takes to make pints of beer. Heineken are committed to net zero. So this is all predicated on a shift from Milton Friedman, the sole purpose of a company is profit, to a much more holistic, there's another great book called Be a Good Ancestor, and what it means to think in generations. So think about the Queen. She was born in 1926. She has children. She has grandchildren. She has great-grandchildren. Her great-grandchildren will be alive in 2120. Start thinking in 2120 space and work backwards. So yeah, I'd love to talk, Charlotte, about this more broadly, but this is very focused on oil and gas. But the whole premise of ESG investing is this transition to a sustainable economic model. So it's a complete reinvention of the philosophy of economics and capitalism.
Super, thank you, Charlotte. Just to kind of get more people into the conversation, I'm going to move on, but thank you for your question. Next, we're going to come to Colette Cohen, who's actually the CEO of OGTC. So Colette, if you're unmuted, please go ahead.
Okay, thank you. I hope you can hear me.
Yeah.
So, Robert, really enjoyed the talk and super grateful for the previous question on donut economics, because that was my, I was going to try and fit 2 questions into this by cheating. So we'll move on. What I'm really curious about is you mentioned it in a number of slides, but hidden were the actual words disinvest in fossil fuels as one of your strategies. And I'm also a Just Transition Commissioner, and I really have a problem with language and the unintended consequences of that language. Because when you discussed how you were actually planning to invest, you were also talking about if companies have the appropriate commitment to net zero and a plan to support it, you would invest in them. So hence, fossil fuel companies could actually meet that criteria. But the language you were using is very binary. It's either we will or we won't. And I'm wondering, is there something more that we could do? Because recognizing that fossil fuels are actually required for us to be able to deliver the huge growth we need in wind, in hydrogen, in all of the desired outcomes we want for net zero. We actually need fossil fuels as part of that transitional journey. So is there something more we could do around this binary language that I think really pits particularly the oil and gas industry nearly against everybody else? And that's not where we want to be.
Yeah, look, I think that's a great question, Colette. And look, firstly, I don't think they were my words, but they are literally words taken from net zero or TCFD language, and therefore I was showing you what we've committed to. So they're not our investment beliefs. Our investment beliefs are very clear on engagement, and that's what I was trying to show you. Those were the physical investments that we have in BP and Shell. I mean, we've got, as I said, we've got like over 2% of 135 billion pounds invested in oil and gas, and that's predominantly in BP and Shell and Total, and not in Exxon and Chevron and other companies. So I think hopefully that brings that point to light. In later this year, we're relaunching a fund which is about 13 billion pounds, which will be a low carbon fund to help us transition and meet our commitments. The easiest thing to do for us to do that is to divest. By the way, 30% of our carbon footprint comes from just 20 stocks out of 4,000. So we've got 4,000 investments, and a third of our total carbon footprint comes from just 20 securities. So achieving that, the easiest thing would be to take it out, but that is not the answer. The goal here is to get BP and Shell to transition. The goal here is to get Volkswagen to transition. The goal here is to get Mercedes to transition. The goal here is to get people like Singapore have committed Singapore Airlines to reduce the carbon footprint of Singapore Airlines by 2% a year on year. KLM are trying to think about how do we do EV pieces. The reality though, if I may, and the oil and gas industry has been in denial for 40 years. We all know research was published. The industry knew full well in the 1980s the impact of CO2 and what this would mean, and accurately predicted that we'd be at 420 parts per million. So I think there needs to be engagement on both sides, but the goal here is absolutely for companies like BP and Shell and Total who are up for it to make it work and to encourage them to transition. But the only way to get people to act is to divest in extremis, but in extremis, not carte blanche.
Super. Thank you.
Thanks.
Thank you so much, Colette, for a great question. And Rob, I want to bring some more people in from the audience. So next we're going to go to Adam Beardmore. Adam, could you pose your question, please?
Yeah, thanks, Rob, for the presentation. Really interesting. So probably 2 questions here. So when you're comparing investment decisions and the risks between the assets, how do you assess and justify kind of for energy transition projects, the risk associated with those developing kind of market and uncertainties around policy? And then I guess building on that, for projects or assets that are looking at these, is there certain metrics or information that needs to be made more clearer for the investment community that would help kind of attract future investment in transition projects?
Great question, Adam. So we don't make any security decisions ourselves. All we do is set the policy for those 38, 39 fund managers that we work with. And what we're trying to say is, what is your process for assessing it? What we don't want people to do is not invest in low. What people can very lazily do is just get ESG data from MSCI or Sustainalytics and just invest in the best ones. The reality is the correlation between those two is basically zero. And right now there is no kind of like audited level of comparison of kind of ESG metrics from one company to the other. What we want to understand is, why is this person investing in this company? So take investing in emerging markets, you naturally forced to invest in companies that probably start from a lower bar. But actually what we're looking for is investors who go, yeah, but they've just put in this new CEO, they've changed the board, and their delta of change means that actually they're going to make themselves a better company. So what we're looking for is the second order derivative, the direction that they're going in, at the pace at which they're moving, rather than their starting point. Again, when it comes to investing, we don't, we have Jennison that's been invested in Tesla for years, and they engaged with Tesla a few years ago when Elon Musk tweeted that he was going to take his public private, which is a big no-no. You can't do that. And they made it crystal clear that we'll divest if you ever do that again, and you've got to make some changes. We've got another investor, Pisna, which I shared, which doesn't like Tesla, more from a valuation perspective, but likes VW. As we know, VW not that long ago had some serious CO2 emissions. They were kind of basically cooking the numbers. So what we're looking for is our investors to demonstrate that they've got Sherlock Holmes-like capability to be able to deep dive into these companies and really get a sense on, are they doing the right things or not? And really, we're paying them to make that pricing judgment. But if you're saying from a company perspective, you always want to be presenting your data in the best way to make your business as attractive as possible for people to invest in.
Super. Thank you, Adam, for that question. I really want to get as many questions in as possible. So Charles Leslie's teed up, I think. Charles, can you go ahead, please?
Right. Hello, can you hear me?
We can hear you.
Charles.
Yeah, okay. Excellent presentation, very thought-provoking. I've got two questions, but one of them is there not more of a future investment-wise in hydrogen transport? Because the electric vehicles are really nowhere near as green as we're led to believe. And that's going to become apparent.
Yeah, was there a second question, or was that your...
Second question was carbon capture and storage is going to be essential to meet net zero. And it can be done now. So are we investing enough to make it happen?
So on the hydrogen, I actually took out a slide, but I had the Transport for London commitment to have all of their London buses green by, I think it's 2027. So depending on what bus you get in London, some of them are EV and some of them are hydrogen. Not all of their buses are going to be EV, and some of them will be hydrogen. Not all of the transportation. So Singapore is going to get mass urban transportation from 60% to like 85%. Again, that's not all going to be EV. And I think this relates to your second question, and it maybe relates to the question that I had from Colette, which is, Mark Carney talks about the 50 shades of green. And that's the problem. This is not a binary, oil and gas is bad and renewable is good. The reality is we cannot switch off one to the other today. And we need to transition, and we need these 50 shades of green in between. And we need to be doing all of these things together collectively to create that outcome. And I think here's the challenge, which is, I think you've got all these institutional investors and banks and insurance companies waking up, and the easy answer is to jump straight there, which will be bad because I think it will cause a pricing bubble in renewables, which is what I think Richard was pointing out at the beginning. And B, it will miss out on the technology that will help us transition from A to B.
Super. Thank you so much, Charles, for your question. I think we've got time for maybe one more. I'd like to bring Neil Sims in, please, if you're free to speak.
Yeah, hi, thank you. Hi, Robert. Great slides, thank you. I wonder, I saw on one of your slides, you and I didn't catch the whole line, but there was a one line that was talking about absolute and intensity. Much has been discussed certainly in my organization and across multiple industry sectors. Are we shooting for absolute, or are we shooting for a reduction in intensity? Because they're quite different.
Yeah, good question. I think, look, the reality is, I don't think anyone has the right answers yet. I think, if we think about coming up with our TCFD reports, or even in our own commitments, as I speak to other large asset owners, one of my colleagues right now are on a kind of on a call with the BT pension fund, and we're knowledge sharing, and we speak to the Brunel pension fund, so we all kind of knowledge share with each other. I think, look, part of the issue is that everyone's trying to sort of figure this out at the right way and the right pace. I think the reality is it's both.
Super. And I think I can actually move on to get maybe one last question in from Amici Halim. So Amici, hopefully I pronounced your name correctly. Could you please pose your question?
Hi, thanks for allowing me to answer the question. Yes, you pronounced it correctly. Thank you for your presentation. I've been waiting for it for quite a while. SMEs in the UK make up nearly 100% of UK enterprises and 60% of private sector jobs. Most of the biggest CO2 emissions reductions in the UK since 1990 have been from energy supply, waste, and business. 54% of the remaining emissions that we need to cut come from transport, business, and agriculture, a good portion from SMEs. How will further emissions reductions and ESG improvements be tackled within this big, very disparate group, since most of the regulations we have today or initiatives are focused on big companies, but the little companies seem to have been left out of it. So yeah, that's my question.
Yeah, I think what people don't, the stuff that I'm sharing is coming to all companies. So in the same way that back in 2012, when Pensions A Day was rolled out, it started with the biggest employers, and then everyone has to offer a pension for their employees. The same is happening. Of course, you start with the biggest companies and it trickles down, but TCFD is going to be for everyone. As I said, the reason I shared that Theresa May thing is net zero is for, if you're operating in the UK, you will have to comply with this. I think the other reason why I was trying to show you the NatWest and the Santander and the HSBC is when they think about their lending and all the rest. The reality, though, is people probably haven't spoken to the SMEs about preparing for it. The probably more mature SMEs who are probably thinking about an exit or fundraising or all the rest will start to have to think about these things, because they will be feeding in. But you're absolutely right. This is not just about oil and gas. I mean, the food industry is one of the most wasteful on the planet. I'm a huge fan of anything that goes to addressing food waste, and so we need to tackle this in all areas: transportation, food waste, energy, and all the rest. And you're right, the SME as an aggregate population of companies is a material economic player in all of this part. And I suppose this is where companies like BGF are so important, right? Because I mean, you're supporting SMEs up and down. You're the largest provider of funding to SMEs in the UK, or private equity funding to SMEs. And I think this is where it all starts to come full circle.
That's such a great question to finish on. I'm conscious of time. We're almost at the half-past mark. I need to have time to say thank you. Thank you to Rob for such a really thought-provoking presentation. And because we had so many great questions stacked up from the audience who wanted to ask you, about that presentation, we kind of focused in on you rather than brought the rest of the panel in. And I hope they understand it made for a really fast fire session, and it was very, very informative. Thank you to our panel for providing ballast after the presentation, and thanks to everyone who joined us today for another cracking Insight 60. Please join us on the 17th of March for our next Insight 60. We'll be looking at the challenges of academic research and industry collaboration, and we'll have none other than Sir Jim MacDonald, who runs Strathclyde University, presenting on that topic. So he's a great speaker. So please have a great Friday, great weekend, everyone, and look forward to next Insight 60. Thank you, Rob. Thank you, panel. Job well done.
Thank you, everybody.
Thanks. Have a good weekend.